Brooklyn Mad Money. Welcome to Cramerica. I'm going to make friends. I'm just trying to make you a little money. My job's not just to entertain you, but to educate, teach you. So call me 1-800-743-CBC. Tweet me, Jim Cramer. Here we go again. The headlines appear right about now as the summer runs out, as they always do. Tech rally shows signs of losing steam, says the Wall Street Journal. Doubts about artificial intelligence and a rotation to previously unloved sectors slow tech gains, end quote. Isn't that it? In a nutshell. Sell. So on a day when the Dow shed 349 points, S&P dipped 0.43%, although the Nasdaq declined just 0.22%. Everybody's worried about the need to dump the mega cap tech stocks because everyone else is dumping them. Yes, get out before everyone else gets out. Now that's some genuine Wall Street homespun wisdom. Let me just say before I deconstruct this view that I used to actually live by this gospel at my old hedge fund. I reason that the summer's always pretty lousy for tech, probably because there are plenty of customers who go slow or close down for the summer, especially in Europe. Heck, I used to short tech stocks at this point in the year, figuring, well, what could possibly happen in the third month of a quarter other than a shortfall, negative pre-announcement? Plus, you can always just buy them back, right? What's the difference? The negative narrative continues. Nvidia and Microsoft pick up almost 15% of the market. How ridiculous is that? That's the highest concentration ever. That can't last. Seems like a dangerous compass, one that has to unravel when Nvidia reports on Wednesday. More. The group is tired. But there's nothing tired about the small caps. They've been resting. They're ready. Sell mega cap. Buy small. There. I gave you the total textbook negativity. Now I'm going to give you the counterpoint. First, as I write in How to Make Money in Any Market, which comes out September 30th, he said shamelessly, you are not a hedge fund manager. And even if you were a hedge fund manager, I disagree now with the strategy, even as I adopted it. You're just trading because others are trading. Now, why is that so bad? It's because of the precision needed to execute this kind of thing. Eventually, the money always comes back to growth. So when you dump these tremendous growth stocks now, you have to figure out when you can get back in later. And that is much harder than it looks. So I'm going to give you a textbook example. What happens, say, if you dump the stock of Alphabet, a former core position of my Chapel Trust that I sold, betting the Justice Department really hurt them now that the court ruled them as a monopolist? The stock went down for the price of a cup of coffee, right? I mean, and then on the news, it caused me to sell. And then it went up 30 straight points. Did I get back in? No. Did the Justice Department destroy them? Who knows? They haven't ruled. And even if they did, what are they going to do? Break it up? If you break up Alphabet, you get a bunch of businesses that would be worth more on their own. Google, YouTube, Gemini, Google Cloud. The Justice Department Waymo. The Justice Department would be doing shareholders a favor. I don't believe in woulda, shoulda, coulda, but as I tell club members, I do have tremendous remorse about this sale. And that's why when it comes to these mega caps, it's almost impossible to pick your moment to sell and then buy them back later at a lower price, as I wanted to do with Alphabet. I couldn't do it. The stories like the one in today's journal are the sotto voce enemy because they're based on seasonal factors that you have no control over and you don't know how or when they're going to end. I regard them as no more valuable than a statistic I heard on our air today, that when you have 9-to-1 upside to downside volume, as we had on Friday, it's a huge day, 91% of the time we're up big a year later. But maybe we're part of the other 9%. The inability to reliably get back in is one of the reasons why I always say to own Apple, don't trade it. Apple's a great example. Let's go into it. Think about the amazing company and its incredible stock. Sure, it's down this year. Okay? Bad. Yes, it doesn't have an AI strategy that's yet self-evident. Siri may be even less intelligent than Alexa, the living embodiment of a computer with a lobotomy. The new Alexa is smarter. What say you, Siri? But then last week, you're on vacation. You're off the coast of Croatia. You're going to some secret hidden places, the real Blue Lagoon. Not the swimming pool, somewhat Blue Lagoon off of Italy. It's the much larger one near the UNESCO World Heritage Town of Trogir. Okay, Trogir. The one where you have to duck your head to be sure you don't have it sheared off by the small aperture that you need to get into this special place. And what happens when you get there? Well, how about everybody whipping out their iPhones to take pictures? Boats and boats of people seeking to validate and remember using a product that's the best there is. See, as long as the iPhone remains the best phone out there, then selling Apple to buy it back later is a mug's game. I couldn't believe it. Everybody It's like it didn't happen if they didn't do it. That's my wife. Now, let's deal with Nvidia and its earnings report this Wednesday. Are there some concerns? Sure. There's China demand, which the usual trash cyber rags. It's amazing. There are trash cyber rags like there used to be, like yellow journalism. They got them. They tell us the demand is waning. Do you know when they're going to start shipping the new chips? I don't know. Maybe there's no demand for them. And most important of all, when do the big spending hyperscalers lose their appetite for these expensive chips? Soon, right? Soon. It can't keep going on without a payoff, right? And then Nvidia will no longer be king of the hill, top of the heap. Sinatra. To which I say, we live in a biased world. We've loved enterprise software and disdained semiconductor stocks for decades. We like the evergreen nature of enterprise software and disdain the episodic nature of semis. When venture capital firms in Silicon Valley have pooled the resources for decades, they go for software, not hardware, right? Sure, truly that had been the case. But now, just as software ate hardware, now AI is eating software, as Cramer pal Ben Wright just put it over at Melius. That's a research firm. Hardware is to the future as software used to be to the future. You can't have generative AI without NVIDIA because we haven't seen generative AI yet that is all that different from a souped-up Google. Look out. The next generation will be more accurate, maybe much more, because the engines will have made deals with the intellectual properties behind the paywalls rather than just sourcing their answers off of Reddit and Wikipedia. I like both those sources, but I wouldn't exactly call them 100% accurate. More important, the new NVIDIA chips will allow the chatbots to reason. They'll actually be able to argue with you to get a better answer. Do you really think AI spending is headed lower, not higher, when NVIDIA has chips that will allow you to ask your system questions and it comes back with questions to you to get the answer right? Reasoning will be the holy grail of this whole AI generation. Okay, that's it. And people are selling these stocks ahead of that change. That's downright unreasonable. I think anyone who refuses to buy NVIDIA's chips will be left behind. In the great hyperscaler arms race, you can't afford to be left behind. Bing. Now let's step back and think about this small cap thing. Sure, as a whole, they may be better, but if you take them apart, open the bushel of stocks versus, trust me, you don't even want to know what you're buying. So you chow down on an ETF and bet that others will do the same. Historically, not really a great strategy. Just another greater fool thing. Now, you may say, well, Jim, these big tech stocks are tired. They're jet lagged. I come back and say, well, wait a second. Stocks aren't people. They aren't animals. They don't get sleepy. They don't go down for nappies. The concept is per se ridiculous. Will you let me know when Amazon's had a good night's sleep, please? Or Microsoft? Has it had enough? Is it over that melatonin fix? Which of the Mag 7's going on a hefty dose of Seroquel? So let me give you the bottom line here. I will never try to stop you from selling. That's not my job. I just want you to remember how these individual stocks have generated tremendous wealth for those who have held on. You made that money by sticking with them through thick and thin, not by trading in and out of it. No one's that good, people, and you will be leaving your fortune, on the table. Now we're going to take questions. We're going to start with Stephen in Ohio. Stephen.
Hey, Jimmy. I used to live out of my car, too. Question for you. Is now a good time to get a position started in Salesforce?
Okay, Salesforce, great question. I've owned the stock for, I don't know, more than a decade. Here's the problem. It's enterprise software. And right now, the long knives are out for enterprise software. I need to see the quarter before I tell you that. We own a small position for the Travel Trust. We used to have a very big position. I'm nervous about exactly what I just laid out, which is this enterprise software, of which Salesforce is very much involved in, even its agentics, which is marvelous, is part of the software cohort. All right, now look, I don't want to stop you from selling, but you have to remember how much wealth has been generated from holding these individual tech stocks through thick and thin. That's how to make the money. On Mad Money tonight, shares of Home Depot have moved higher despite reporting a top and bottom line miss last week. So is this name on a solid foundation or is it in need of a full remodel? I'm running through the quarterly numbers to find out. Then the healthcare sector has been taken to the woodshed this year, but CVS Health, no, it's managed to stay above the fray. I'm breaking that down to see what's fueled the rally for the drugstore chain. And everyone loves a comeback story. Tonight, I'm going to look at the transformation happening at Pitney Bowes with the company's new CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
While I was away last week, we got results from Cramer Fave Home Depot, a stock I'm very happy to own for the charitable trust. But the numbers confused a lot of people. Sell, 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 sell. See, at first glance, the headline results looked underwhelming. Home Depot's revenue came in a little light, and their earnings per share also fell a little shy of Wall Street's expectations, basically flat year over year. Well, that's why when the results hit at 6 a.m. sharp last Tuesday, the stock initially dropped nearly 2% on the news. Sell, sell, sell. But by the end of the day, Home Depot's shares had climbed more than 3%. So what gave the buyers the confidence to rally behind this one after what initially seemed like a suboptimal quarter? Simple. The quarter was good. See, you can't judge earnings by the headline numbers alone, something I've stressed repeatedly to you, both on air and, of course, with members of the CVS Investing Club. When it comes to Home Depot, management painted a much stronger picture on the conference call than they did in the headlines, obviously, giving investors plenty of reasons to stick around. There was nuance, and nuance favored the bulls. For starters, management emphasized that the momentum they saw in the back half of last year carried into the first half of this year. They even described last quarter's performance across the business as, quote, the strongest we've seen in over 2 years, end quote. So if last quarter's performance was that strong, why the shortfall versus Wall Street's estimates? Some of it was poor weather. Poor conditions in early spring, as I know, as a gardener, dampened sales at the start of the quarter, although those numbers improved later on. Which brings me to the second positive, what's known as the cadence, C-A-D-E-N-C, you know this word, of the quarter. While Home Depot's same-store sales were up just 1%, right, not so great, things look different when you examine them month to month to month. After being dragged down by a weaker May, that was that weather, saw same-store sales decline 0.3%. That improved to flat in June and then accelerated to plus 3.1% in July. At the same time, that was a sequential improvement from down 0.3% in the previous quarter. In short, things are getting better and better for Home Depot. By the way, hedge funds love to hear cadence because a stronger month-to-month pace can be extrapolated. And that was a huge part of last week's move. And you couldn't tell cadence from the morning headlines. Wait for the call, people. Wait for the call. Management highlighted they're seeing broad-based strength in the business with 12 of their 16 merchandising categories posting positive same-store sales. That's very positive. That includes important categories like storage, building materials, kitchen, and my favorite, outdoor garden. Even better, some same-store sales, get this, for professional contractors and do-it-yourself customers were positive. Good to see both. The professional business remains a key competitive edge for Home Depot, as it represents 55% of their sales, which is much higher than Lowe's, which is about 30% professional. Rather than chasing regular consumers wanting to do it themselves, see, the despot has been making acquisitions to expand its range to offering to contractors. So last year, they paid $18.25 billion to buy SRS Distribution. Some people thought that was too high, but it's really working out. It's giving them more exposure to roofers, landscapers, pool contractors. Earlier this year, we learned that the SRS subsidiary will be acquiring a company called GMS, which is a distributor of specialty building products, ceilings. These two acquisitions are something even more valuable, distribution capacity. Once the GMS deal closes, SRS will boast more than 1,200 locations, over 3,500 associates, nearly 8,000 trucks that management says are capable of making, quote, tens of thousands of job site deliveries per day, end quote. That's business Home Depot can't get enough of. Management is incredibly bullish on these distribution points because they've seen the numbers. As they put it on the conference call, these distribution centers are, quote, generating higher returns on invested capital than an equivalent Home Depot store would at this point in its life cycle, end quote. You know, so that is really impressive. I'll tell you why. Management said on the call, a Home Depot store to us is almost like buying treasuries, and that is as close to the most confident return we can drive this business. Yet, as much as they like putting up new stores, it's the distribution centers for professional contractors that are an even better investment. I love that bit of detail. Home Depot's always had a great conference call, but that was one of the best moments. Now, and look, I get it. Last quarter, management noted that they now have the most products in company history available for same-day or next-day delivery. That matters because customers who use these services spend more and shop more often. Put it plainly, management says that the SRS acquisition, quote, has exceeded our expectations. But it's not just about the last quarter. On the conference call, management acknowledged that the momentum they're seeing in July has carried through to the first 2 weeks of the current quarter. That makes me feel a lot more confident about, say, Halloween and Christmas. Sure, it might be early to start decorating for the holidays, but that isn't dampening management's excitement about the return of Halloween fan favorites like Skelly, the 12-foot skeleton, a 7-foot long canine skeleton best friend, Barkley. Wrong Barkley for me. But if they start selling 12-foot Saquon statues, count me in. Next Thursday's the opener. That's why, despite the headline miss for the quarter, Home Depot was still confident enough to reiterate their full-year forecast. People love that. And that guidance doesn't assume any help from lower interest rates, something that's now very much on the table after we heard from Jay Powell last week. Anything connected to housing does better with lower rates. Anything. Remember, management said that since 2019, this was incredible, home prices have now appreciated by 50%. Which means that homeowners are sitting on home values that management estimates are worth roughly $11 trillion. But elevated interest rates have made it tough for homeowners to tap into that equity, which is bad for Home Depot. A lot of people can't remodel without a home equity loan, and they won't take out that loan if the rates are too high. And that's why Fed Chair Jay Powell's dovish remarks on Friday sparked another 3% and change rally in the stock, as lower short-term rates will translate into cheaper home equity loans, which are based on the price of short-term money. At the same time, management called out economic uncertainty as the primary reason for these delays in larger renovation projects. Yes, uncertainty. Now, that's it. They're confident the one big beautiful bill with its tax cuts and Trump-branded baby bonds could act as a powerful stimulus for the consumer. Great verbiage in the conference call about why that matters, because a lot of people just kind of, their eyes glaze over the bill. Now, you might be worried about the impact of tariffs on Home Depot's profitability, but in the conference call, management reminded us that 50% of their goods are sourced domestically. So there will be a tariff hit, but it will be much smaller than you might have expected. While there will be some price movements, it likely won't be too broad-based. As a result, management expects to see gross margin improvement in the second half of the year. No one expected that, believe me. Here's the bottom line. Despite the softer headline numbers, the details we got from Home Depot show a business that's gaining strength, especially with the prospect of lower interest rates on the horizon. That's why I am confident that Home Depot's long-term story and why the stock rallied in response to the quarter that many investors wrote off immediately is just so intact. That's because they didn't listen to the conference call. Now, if you're a member of the Investing Club, you would know we are holding this one for the long term. And the move up that we saw last week, believe me, you ain't seen nothing yet from Home Depot. Their money's back after the break. This has been a very good year for stocks in general. S&P up 9% year to date, but it hasn't been a good year for the healthcare sector. The biopharma companies are struggling to adapt to the Trump administration, especially the Department of Health and Human Services under RFK Jr. They don't like the presidential browbeating on drug prices with the prospect of tariffs on pharmaceuticals either. Sell. Meanwhile, the managed care sector is in shambles as people are simply getting much more health care than they're used to, and their insurance companies haven't been charging them enough. But tonight I want to talk to you about one of the rare healthcare stocks that's proven to be a port in the storm, and it is a shocker, people. It is CVS Health. Yeah, the drugstore chain with a pharmacy benefit manager, Caremark, and a managed care business, Aetna. This has been the best performer, get this, in the healthcare sector in the S&P. It's up more than 58% for the year. How the heck did CVS pull that off? All right, now some of this is because CVS has become the last man standing in the retail pharmacy space, as its last major rival, Walgreens, is set to be taken private and plans to close hundreds of stores in the process, while Rite Aid suffering through its second bankruptcy by shrinking beyond all recognition. But some of it's simply because the stock of CVS already got pulverized last year. It was down 43%. It was the 10th worst performer in the S&P. Problem came from Aetna, their managed care business, which was crushed by all the things that have wrecked the healthcare industry stocks this year. Specifically, the prices were too low in a world of higher than expected medical costs, especially with their Medicare Advantage plans. In other words, what they did really bad last year is what some other companies are doing this year. Now, I bring that up because I have to, because this year, CVS is finally seeing a turnaround from the managed care side of the business. Now, it's not a great performance, but it's definitely a better one. When CVS reported at the end of July, their healthcare benefits division, which houses the managed care business, saw nearly 12% revenue growth, with operating income up almost 40% year over year. Basically, the health insurance side is doing much, much better. That's an index where lower, by the way, is better. CVS acknowledged that medical utilization rates remain elevated, but the company's finally getting its arms around the issue. CVS medical benefits ratio, which measures the cost of care as a percentage of total premiums received, clocked in at 89.9%. Now, that was up 30 basis points a year over year, but it was a full 80 basis points lower than Wall Street was expecting. Crucially, that number included a large, quote, premium deficiency reserve charge that the company took to reflect higher utilization trends, and it covers their anticipated Medicare Advantage losses through the rest of the year. What a sloppy thing, but they all had to go through this. And that was only one part of overall, though, was a great quarter from CVS versus the other companies in the cohort. And that's something, therefore, that sent the stock soaring over the past month. The drugstore chain posted substantially higher than expected revenue, with all three of their businesses, the pharmacy, the benefits manager, and the managed care division, coming in ahead of expectations. So on top of that, CVS posted a phenomenal 35-cent earnings beat off a $1.46 basis. Since then, the stock's rallied from the high 50s to the low 70s. It's cut more, I think. I don't think it's done. Now, this represents a major transformation for CVS. Now, I want you to keep in mind, last year, management had to cut their full-year forecast multiple times, driving investors crazy, forcing many to abandon the stock along the way. But for the second consecutive year, CVS raised its full-year forecast, and this was a huge raise. They took the revenue guidance up by nearly $9 billion. Wow. And they boosted their full-year earnings outlook by 25 cents at the midpoint. And it's not just because their health insurance business has managed to stem the bleeding. The drugstore and the pharmacy benefits manager are also doing great. The health service division, which includes the Caremark PBM business and the in-store medical clinics, put up a 10.2% revenue growth. Very strong. As for the drugstore business, do you know that both the front of the store and the pharmacy, it delivered a $1.5 billion revenue beat? Operating income up 7.6% year over year. We haven't seen numbers like this from a drugstore chain in ages. Like I mentioned before, CVS is cleaning up because its main competitors have more or less surrendered. Walgreens is in retrenchment mode as it's being taken private. Rite Aid, or what's left of it, frankly, just filed for bankruptcy again in May, second time. That leaves the field to CVS, which is taking market share like crazy. You know, look, Amazon's in there, but the brick and mortar, these guys are winning. It's especially true on the pharmacy side. Comparable pharmacy sales were up 18% year over year. I don't know about you. I had Rite Aid. They sent me to, when they closed, they sent me to CVS. That's happening all over the country. It is good to be the last man standing. Now, that's something, by the way, you would have known had you watched the Bruce Willis movie of the same name. So from end to end, CVS business is simply doing much better than it was 12 months ago. The sore spot managed care business isn't exactly thriving, but it's much stronger than anticipated and seems to have gotten its arms around the most pressing problem, higher medical utilization rates. Meanwhile, the biggest division, health services, is powering forward as Caremark continues to perform well, and increasingly powerful pharmacy business is driving surprisingly strong numbers on the drugstore side because CVS no longer has any major rivals. I bring all this up because, though the stock's up over 58% for the year, do you know this thing only sells for just 11 times the midpoint of its new full-year earnings forecast? 11. That's ridiculously cheap. But, oh, by the way, the company pays a $2.66 annual dividend. Stock sports a bountiful 3.7% yield. You got to hand it to CEO David Joyner, who's done some remarkable work in the first 10 months of the job. I really like this guy. He's sharp. He gets it. He knew where the problems are, quickly addresses them. And some of the other parts of the healthcare that we're working this year, like the medical device space, prices to earnings multiples, they've become really elevated, making the stocks much more risky simply because they've gotten ahead of themselves. That's not a problem here. Last year, CVS's stock was priced like the company was good. Well, I don't want to say go out of business necessarily, but you know what I mean. They had these. The management just kept cutting their full-year forecast over and over and over again. Even though the stock's rebounded substantially from those levels, it's still super cheap now if the numbers are going up higher. I'm clearly not alone in thinking this. By the way, last Monday, analysts at UBS upgraded CVS to a buy following 2 strong consecutive quarters of execution and early signs that the healthcare benefit segment fixes are on track. I feel the same way. Let me give you the bottom line here in this very exciting story. Healthcare has been horrendous this year, but CVS, one of the worst performers in the entire market in 2024, you need that preface, has proven to be a port and storm for healthcare investors. It is up 58%, leads the entire cohort. fixing its most problematic business, managed care, and seeing real strength in other parts of the business, especially the pharmacy side, where it is the last man standing. Plus, given the cheapness of the stock, generosity of the dividend yield, here's what I'm saying. Buy CVS. Summer in Connecticut. It is summer in Connecticut. Summer in Connecticut.
Hey, Jim, it's Sumner. Hey, this stock's
Sumner,
down 40%
how you doing? How you doing?
Yeah, not a problem.
Right.
The stock's down 40% on the year. It looks like it's stabilized, and with the likes of Warren Buffett buying it, do you think now is a good time to start a position in UNH? Go Bird.
Okay, so I have these rules which say don't buy one of these things because it looks like it's done a lot of things wrong. That Buffett does not, the fact that they're buying it doesn't influence me. What I want to hear is from the company. The company comes on the show, tells the right story. I will be behind it, lock, stock, and barrel. But they got to come on, and they got to answer the tough questions. Plain and simple. That's what you want. That's what I promise. The turnaround at CVS is well underway, and given how cheap it is, it's that generous dividend, I bet this name has more room to run. Watch where I made money. I include my sit down. Oh boy, this is going to be terrific. With Pitney Bowes PBI, it's the global mailing and shipping company, midst of a major transformation. I'm getting firsthand account of the turnaround here with the company's top brass. I got to tell you something. There may be something here too. Long knives out for the federal government's deal with Intel, but I'll break down why I think this was an intelligent investment by the Trump administration that's also good for shareholders of Intel. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. All right, what do we make of this incredible rebound in the stock of Pitney Bowes? It's up nearly 71% year to date. Now, a lot of people still see this company as a play on mail, meaning old-fashioned snail mail, because their core business used to be mail meters and equipment that helped offices send postage. As you might imagine, the stock spent decades in the doghouse. From its peak in 1999 to its lows in April 2020, Pitney Bowes lost, get this, 98% of its value. Even in late 2022, the stock was still trading at just around $2 and change. Then an activist stepped in, a guy named Kurt Wolf of Hestia Capital. He took his activist campaign public in December of 2022, got himself on the board of directors after a proxy fight in the spring of 2023. Over the past couple of years, with the activists on the board, Pitney Bowes has divested money-losing lines of business, reduced its debt, repurchased shares, and this company has now repeatedly raised its dividend. This past spring, Wolf took the next step, taking over CEO of Pitney Bowes and vowing to conduct, quote, a comprehensive strategic review, end quote, for the remainder of the year. And look, it's already paying off. Since Wolf got involved in the stock's up more than 400%. So how does activists turn this business around? Let's take a closer look with Kurt Wolf. He's the new CEO of Pitney Bowes. Find out. Mr. Wolf, welcome to Mad Money.
Thanks for having me on, Jim. Appreciate the opportunity.
Absolutely. So first, Kurt, people should understand, you took a position, you have a huge amount of money invested yourself. You saw a hidden gem, I imagine, yes, but you also knew it was hemorrhaging cash, and you decided to, not only like when you got on GameStop board, right, to say, listen, we got to stop the hemorrhaging, we got to turn this company around.
Absolutely, yeah. And so first off, you talk about having a huge amount invested. I do think it's important to note I have virtually 100% of my own personal net worth invested in this company, just like I did with GameStop. Right. At Hestia Capital, what we do is we look for companies that are significantly undervalued, and what we typically find is good businesses that are just being poorly managed. That was the case with GameStop, and we found that here with Pitney Bowes. And just to give some context of what we've done over the last few years, I appreciate the introduction. You know, if you take a step back and look 2 years ago, we were borrowing at 13% interest rate. So we were in severe financial distress. Now we just issued convertible debt that even after a covered call strategy, we were borrowing at less than 4%. So much more creditworthy. On a free cash flow basis, we previously, 2023, we had $23 million of free cash flow. Now we're projecting $350 million of free cash flow this year. And then finally, our share price, as you highlighted, we were down in the low threes just 2 years ago, and now we're up over $12 a share. So, and what that's really, all those changes, what they've really enabled us to do is focus on our company, which has two incredibly well-positioned businesses, and we can really focus on making the most value out of those.
Let's talk about those two businesses because they are, I think, fabulous, Centech and Presort. But also tell me about their growth, because I know in some cases you're not that happy with the growth yet.
Right, absolutely. So, yeah, I'll go through the two of them. Presort is what we do there, in case some of the viewers aren't familiar with the company. We partner with the post office to make it more cost-effective, lower cost for large mailers to move mail to their customers. And within that space, we are the dominant player. We are the lowest cost player. We're the highest quality player. And we're the highest service player. And as you talk about mail as a declining industry, but people may be surprised to hear we've grown 11 out of the last 12 years. And that's because in the pre-sort space, the rate of decline is pretty slow. And we've been able to use our strong position to continue to gain share. So that's pre-sort. Within SendTech, that kind of breaks into three pieces. We have a mailing meter business, which is an essential service provider to 95% plus of the Fortune 500 companies. Beyond that, the federal government we're a partner with. We're a partner with most state governments, and we're a partner with 500,000 small and medium-sized businesses. And what we do is we help them run their business more efficiently. But that's kind of what people know about us,
right?
And that is shrinking. Beyond that, we've leveraged what we do in the mailing space to get into the shipping software space. And people may be surprised to know we have over $200 million a year in shipping software revenue, and that's continuing to grow. And beyond that, maybe the most surprising thing to people is we do have a bank. So the Pitney Bowes Bank, it's one of 21 ILCs that exist, and it's an incredible. It's a hidden gem. We have a net interest margin of over 7%. If anybody's a bank analyst, they know that's unheard of. We have very low loan losses, so it's just an absolute gem.
And who would you be lending to, like a small business or big?
Absolutely, yes. And yeah.
So you would make a small business that might otherwise, let's say, be eking out more margin. You might make it so that they have higher margins so they can stay in business and grow.
Yeah, we will lend to customers. And then not to get into the complexities of it,
sure.
Our postage meters, we do lease
right.
to our customers because they're considered mints. So customers can't typically own them, so we lease them to them. But beyond that, we take deposits from them for their postage, but we also make business loans. So if somebody's growing their business, they can come to us to get a loan to actually help grow their business.
Okay, so let me give, so I want people to have the perspective here because it's really important. Mark Lautenbach, terrific guy from IBM, yes. Took over the company many years ago. He came on in 2017 when the stock was at 13. And he said, look, we don't really have a lot of growth. So what we're doing is we're moving heavily into e-commerce. Now, at the time, e-commerce was growing really well, but that turned out to be not that great a business.
Right.
Can you tell us what the denouement of that was, since the last our viewers heard was that it was going great guns? Yeah,
again, the strategy there is probably hard to argue with. People supported it, and I understand why people thought it was a good strategy. In the end, the problem was, and this is some of what we're changing within Pitney Bowes, is the execution. So that business, GEC, used to be known as Nugistics, and Todd Everett, who is now on our board, a phenomenal operator. He used to run that business profitably. We took it over, and unfortunately, because of the way we run, historically have operated, we turned it into $150 million a year money-losing business. So we just didn't have the operational efficiency we needed as a business, and that's one of the things we're focused on, is fixing that. So I don't know if the strategy was flawed. The execution was absolutely flawed.
Okay, so how about the buyback, the dividend increase? Is the company strong enough to do that? And how do you feel about the idea that maybe that just, are you worried at all about it possibly becoming, it's something that I know you don't like, a meme stock?
Yeah. So as far as becoming a meme stock, that's beyond our control.
GameStop, yes. I know you resigned from the board. I don't think you were happy with the way that it became a meme stock as opposed to the cut costs, do a good job, and get better through growth that way.
Yes, and when we became a meme stock, it completely changed what we were doing and what we could do. I had run on a very clear strategy, cutting costs, improving operational efficiency, investing in some new areas for growth. We had a very sound operational strategic plan. When the whole meme stock rally happened, it is what it is. That wasn't my skill set, not how we invest. So we moved on.
I'm glad. Now, I mean, I know that you're doing the review now, so you're not sure yet about where to put your chips yet for growth. Will you have enough money to do the growth when you come up with your game plan? Maybe it's an acquisition. Maybe it's a new direction that we don't know yet.
Absolutely. Yeah, we definitely will have that. We're a $2 billion market cap company that generates $350 million of free cash flow a year. And I think we can build on that over the coming years. So I guess what I'd say is right now, as I mentioned, the GEC business could have been the right strategy, but the e-commerce business, yes. So that could have been the right strategy if we'd executed better. My concern is that we need to fix our business. And I'd use an analogy. I know you're a big Eagles fan.
Yes, I am.
you guys won a Super Bowl, right? And that was based on having arguably the best offensive line in the league and one of the best defensive lines in the league. And that's, I think a core business tenet. It's in the trenches. It's getting the blocking and tackling right. And that's what we need to do within Pitney Bowes. So in the short term, we're focused on getting the blocking and tackling right. A year from now, 6 months from now, we'll be past that, and it'll be a lot easier to grow when we're a better run company.
This is a clean story. I think you're taking the right approach. Of course, obviously, my vested interest is I really want you to help those small businesses, which is what you're doing, because that's the backbone of America. But I really appreciate you coming on the show. There's not enough analyst coverage. You should have more.
Yes.
I think the turn sounds very for real because of the fundament and the cash. And I salute you for what you've done.
I appreciate it, Jim. Thank you very much.
Absolutely. That's Kurt Wolff. He's the CEO of Pitney Bowes, PBI. Look, there's just a ton of stuff. I mean, everything is available. You can find out yourself if you want to do it, including a very clear letter about what Kurt's up to. And by the way, I found a Reuters story which said he just pointed out when they did all that meme stuff, I don't want this to be a meme stock. That's not what this is about. This is about business. Man, money's back in here.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
My staff versus the body. Play this out. And then the lightning round is over. Are you ready, Ski Dad? The lightning round comes. Let's start with Mike in California. Mike.
Booyah, Jim. Thanks for taking my call.
Of course,
Jim,
Mike. What's shaking?
What are your thoughts on Robinhood?
All right, Robinhood's had an extraordinary move. And usually when you have these extraordinary moves, you got to let it kind of calm down a little. So I say let it calm down, but don't forget, it's an up stock. Let's go to Ike in Georgia. Ike.
Booyah, Jim.
Extraordinary booyah to start the day. What's going on?
Not much, man. I called you in September 2023 when Palantir was trading at $13, and you say you are Mr. Palantir. I ended it with Rudy McFadden. That was a monster call. Thank you for all you do.
Thank you, man. Thank you very much.
Today, I want to know your take on a company that's been delivering strong financial results, benefiting from infrastructure spending, grid modernization, and growing demand for electrical equipment in energy and industrial projects. The company I want you to tell me what you take on today is Powell Industries.
Oh, man, this guy, Ike be the man. This thing is such a great stock. I saw it. It is the great industrial energy infrastructure stock that I wish I owned for the trust. Wow, great call. Let's go to Jordan in New York. Jordan.
Hi, Jim. This name is trading at less than 15 times next year's earnings, a discount to its peers, and has long-term growth tailwinds in the private credit space, 401ks, and global investments. In my opinion, the analysts on the street are hugely underestimating its upside potential. In this market, would you recommend buying Apollo?
You just sold me on Apollo. I love the case. This is a guy. Listen to that guy. He knows more than all the Wall Street guys put together. I think Apollo's a cheap stock. I think this guy, Mark Rowan, I invite him on the show. What's coming on the show? I'm on the show. This company is a very smart company. I am a believer. I'm a believer. Let's go to Kenny in Florida. Kenny.
Hello, Jim. Welcome back, and thank you for all you've done for us home gamers
thank
over
you,
the
Ben.
decades.
Thank you.
This stock involves LiDAR and navigation systems, and now with autonomous vehicles and robots, I have high hopes. My small position has not increased over the past few years and until this year, and the stock, while not yet profitable, has 34% year-over-year revenue growth, a strong balance sheet, and virtually no debt. The stock has quadrupled over the past 5 months, non-parabolically, as oxymoron that seems. What's your opinion on Ouster?
Look, it's a LiDAR play, and I've been historically against LiDAR. I think it's a very expensive stock. It is fine as a spec, but when I talk about autonomous, I always come back once again to Tesla, and I always will. And that, ladies and gentlemen, is the conclusion of the Lightning Round!
The Lightning Round is sponsored by Charles Schwab. Coming up, Intel warned of adverse reactions to the White House's deal for a stake in the company. But Cramer's taking the opposite side of the argument. Hear why next.
Booyah, Jim. Your integrity makes you the booyah saint of Wall Street.
Booyah, Jimmy Chill.
Booyah, Jimmy Chill.
Booyah, Jim.
Quadruple. That's a lot of booyahs. Let's talk about this Intel thing. I know the White House is taking a 10% stake in a semiconductor company. It's unorthodox. But Intel's been a multi-year disaster, and our country needs this company to be on firmer footing. Everybody's focused on how Trump did this by taking an equity position. Nobody's focused on the real story, which is that Intel desperately needed a large cash infusion. Now it's got it from the federal government, so it can now start the great rebuild that can restore its greatness as a semiconductor manufacturer par excellence. We need a healthy, viable Intel because we can't simply rely on Taiwan Semiconductor to manufacture our most advanced chips, not when it's only 100 miles away from China. Unfortunately, Intel has a heinous balance sheet as it committed to building a bunch of semiconductor foundries by a previous CEO could have bankrupted the company, hence the need for the infusion. I know it's unusual, but President Trump's actually using money from the CHIPS Act that was already earmarked for Intel. It just hadn't been spent yet. They need that money, but we can't give it to them for nothing. When it would mean a huge move for the stock without the U.S. getting anything in return. Sure, Intel may have had other sources of cash. Yes, the equity it gave the government was dilutive. But come on, the stock jumped huge when the deal was made. In one fell swoop, the president solved Intel's capital problems, freeing up CEO Lip Bhutan to raise the additional billions that Intel needs to build out semiconductor manufacturing infrastructure, challenge Taiwan Semi, and help get our country on firmer semiconductor footing away from the sphere of Chinese influence. It's very odd to hear complaints about how this president's picking winners and losers or adopting a socialist agenda. You got to understand, this is not about Trump. It's about the truly dire state of Intel. Look at the huge losses this company had to absorb thanks to the ill-advised approach that the messianic former CEO, Pat Gelsinger, had taken to putting up these massive new fabs. Gelsinger decided to build fabs with a model like Taiwan Semi, meaning he designed them for outsourcing. He did so, though, with a build-it-they-shall-come philosophy, but potential customers didn't come. No, they didn't materialize in realistic numbers. At the same time, Gelsinger made this commitment without any comprehension of the weakness of Intel's cash flow and its lack of capital to finish what he wanted to build. He was part of a long line of Intel CEOs who made suboptimal decisions, but his predecessors never rolled the dice like he did. And he saw, and by the way, some industry veterans thought he was on the verge of bankrupting this company. You don't get fired for no reason when you're the CEO of a big cap tech company. Gelsinger was fired because he almost destroyed Intel. New CEO and former Intel board member Lip Bhutan knew about these problems. He decided to become CEO to save the company, not unlike what he did when he saved Cadence Design in 2009. Joe, he gave you a 50 times your return from when he came in. Now he wants to do the same thing at Intel, and after the government freed up those funds in return for a 10% stake, turning a grand equity, I think he's going to pull it off. I didn't understand the criticism of the president on this one. Why shouldn't the government take the stake and get the upside? This is hardly unprecedented. It's not unlike when the government saved Chrysler in 79, reaped a windfall from warrants it took, when it guaranteed a loan that let management similarly save the company. The government took stakes in many institutions that almost failed the Great Recession. It benefited from those stakes when the stocks went up. No one criticized those measures to speak of. Intel is just as important as any of those companies. If anything, it actually may be more important from a national security perspective. As to those who say, okay, who's next? I come back and I say, look, if it's a national security issue and one of our important companies might be failing, you better believe it's going to get bailed out. Doesn't matter if the president's Democrat or Republican. Remember, Trump made this investment with money that was authorized under Biden. Intel could not be allowed to fail, people. End of story. The president gave Intel new life by fixing its balance sheet. Now Intel can recreate its greatness with a proven turnaround artist as CEO Lip Bhutan is. The government wins. The people win. The shareholders win. What more do you want? I don't know. I like to say there's always a bull market somewhere. I promise to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.